Presentation number 1. Now, in this course, we are going to be deciphering synthetic indices, and specifically the boom and crash synthetic indices. So, about Deriv synthetic indices, this section is directly copied and pasted from their official website, and it says Deriv proprietary synthetic indices simulates real-world market movements backed by a cryptographically secure random number generator. These indices are available to trade 24/7 and are unaffected by regular market hours, global events, or market and liquidity. Now let us dive deep and start to analyze this content to actually see how these synthetic indices are built and made. Proprietary synthetic indices. This means these indices are privately owned and managed as a profit-making business under the trademark of Deriv. So proprietary markets where they provide the liquidity, so external factors like general markets, liquidity, global events, or external market factors cannot affect this market. So being a proprietary market can subject prices to some little bit of twitching and tailored in a way that can make ignorant traders lose. So that is why you see by the default framework, volatility increases alongside sizes of contracts to be held, and this can actually be detrimental for traders who don't know their way. So it is their business, a private business, algorithmic business. They make profits from it, and with simple mathematics, we will be able to decipher some of the models that this business operates on. Now, Deriv price delivery algorithm. From somewhere in the website, the first definition I posted, I highlighted this section and I paste it here again for us to deliberate on. There was this section that says cryptographic secure random number generator. So what actually is this? This is an algo. This is an algorithm. This is an algorithm, and the function is it delivers price on their behalf by generating secure random number. So this is to tell you that the price action is computer based. It is generated by computer programming. So for those people that don't know what is an algorithm, it is a process or set rules to be followed in calculations or other problem solving operations, especially by computer. So the process of running these indices pricing is computerized, and this is not a new invention by Deriv. A lot of businesses do computerize their processes. People like Google, Facebook, TikTok, and many more. All of these people have algorithms that runs their businesses and platforms. Now, realizing the underlying logic of all we have concluded, knowing that we are actually trading against computers and that the business is a proprietorship business, a privately owned business, is there possible prognosis for profit? Yes, it is possible. Now, this business is a proprietary business, so it means we are dealing with one entity. Now, another thing is algorithms follow scheduled instructions to carry out problem-solving operations. So examples are as follows. You know your boom and crash series. For example, the boom and crash, they do a very volatile movement. For the boom, we call it the spike, and for the crash, we call it the drop. So the spike or drop in average of 1000 ticks or 500 ticks depends on which of these indexes you are trading, be it boom 1000 or crash 1000, or boom 500 or crash 500. So the programming is going to execute this set rule of dropping or spiking these indexes. Now, another example which is clear is the jump indices algorithm for price delivery. How does this one function? Delivers constant volatilities depend on which of the index you select. So if you select 10, 25, 50 or 75, it is going to give you your selected volatility on a constant with equal probability of up or down jump every 20 minutes. So the price is going to jump just like the way the boom will spike or the crash will drop. Yes, the jump will also do the same thing every 20 minutes, but equal probability of up or down jump in every 20 minutes. And this jump is around 30 times the normal price movements on an average. So all of these informations are copied directly from their website, and you can see evidence of price being delivered by algorithms here. This is not even something we want to doubt. Just analyze the language structure here. You will clearly see it, and if you are someone who is into computers already, programming, you will clearly see that this is very clear just from reading the website. Now, realizing the underlying logic still on this section. Now, knowing some of the markets possess core unchanging significant value is key to understanding the price action delivery model from the price delivery algorithm. So some things are bound to happen. Yes, we are certain that some things are undeniably going to happen in the market, and this leaves us with a more focused prognosis. Like, yes, we know something is going to happen, then we have to focus on where and when it will happen. So for example, the boom must spike, so where and when will it spike? The crash must drop, where will this happen? The jump must jump, where will this happen? All of these are pre-programmed already, and they inevitably must happen in the market unless they decide to default against their own program. Now, the question we asked the other time, is there possible prognosis for profit? Yes. So for us to be able to do this, we need to follow the prints. Whose prints? The proprietor's prints, which is Deriv itself, and the algorithms. If we can work side by side with them, execute trade the way they execute, as close as possible we can imitate them, we will be profitable in this market. Then when we are analyzing and forecasting, we need to use computer language like if this then that. We want to do this for us to be able to realize probability present in every trade setup. The fact is, we cannot beat them. It is a private business. They can do it any way they want, and the potential to actually beat them was not given to us, the masses. Lot sizes are limited, trading accounts, deposits are limited, all of these are limited, and irrespective of the underlying sentiment in the market, prices will never be determined by the sentiment of the masses. Rather, the algorithm output of price delivery is what we will all get. So the algorithm generates random numbers for pricing, so it is what is generated by the algorithm that we will all get as result of price, and not what we, the retail, are doing. Now, where does the retail advantage prevail? So retail have advantages, like very big advantages, when the core value of a market tallies with an institutional footprint. So for example, there is an institutional footprint for boom to go bullish, and this tallies already with the core value of that particular index. Boom to go bullish, there is a footprint there. So this is an advantage to us, the retailers, because it is almost certain, it is of high probability that that particular action is going to actually happen in the market. Then the second one is the market respects the basics of trend analysis and price models. Another one is the market is a sole proprietorship market, so we have only one institutional footpath to track, making it easy to see. So this is not like Forex where you have many institutions participating, trading against themselves. Now we only have a market of the proprietors and the retail. So we don't have so much institutions to actually track footprint of. Now, some price delivery models are inevitable. Some things are bound to happen in the market and they must happen. Boom must spike, crash must drop, jump must jump. So all of these are inevitable in the market and they must happen. Then another advantage is the spreads are very tight. So some people can actually formulate trade patterns that take rapid profits in very close range, and they can be able to do this very successfully. Then the market is cheap to get in. Yes, you can actually even trade with 0.5 cents, $1 in this market, and yes, if you know what you were doing or if you got lucky, you will be able to make tangible returns. Another advantage is when the algorithms repeat certain patterns over and over in a period of time, especially when the market is trending. So you will see a price pattern reoccurring as if the algorithm is stuck in a loop, and this same thing will keep playing over and over. So this is a very big advantage to retail when they see such phenomenon occurring in the market. Then this market is an algorithmic market, so it's basically mathematics. The random number, everything, it is not really random, they are programmed. So yes, mathematics will do you a lot of good in this market to get very high precision entries. Now, retail limitations. There is no retail influence on price. So if boom is selling, there is nothing retail can do to drag the price up as long as the algorithm has not met its objective, or the proprietors are not ready to make a switch to change the direction. There is nothing the retail world can do. Price is just going to continue in the direction of the algorithm in agreement with what the proprietors want. Another thing is limited sizes. So even without the algorithms, actions like short squeezes may barely happen in this particular market. So many retail ineptitudes to understand the indices, financial implications before trading them. So you see somebody who got lucky, or maybe who is a good trader and traded jump 75. Another retail trader would think, oh, this guy flipped $20 to $700 trading jump 75. I'm going to trade it, and then you see them jumping into this market and getting slaughtered. So they have inadequate knowledge of this market before they actually jump in. Then another limitation is insufficient historical data for research. So you see some people, they actually backtest several years of data, like 10 years, 20, 15 historical data, but this market is relatively new. We don't have that level of data here. Then these indices are designed in a model where retail are forced to hold larger leverage positions ignorantly in more volatile indexes. So the explanation actually in the website said you select your index according to your risk appetite. So the thing is, the higher volatilities, they actually are modeled in a way where you hold more contracts. You hold more contracts even as the smallest lot size. So for example, in one of the videos in this channel, we actually talked about this, and we gave illustration of volatility 75, where the minimum contract is actually worth over $6,000 of leverage position, while in index like boom 500, the position is lesser, one lot is lesser than $5,000 or around that range. So it means you are trading 0.001 in volatility 75, but that trade is worth $6,000, and now you are trading one lot size in boom 500, and that trade is approximately $5,000. So all of these models actually make it sometimes difficult for the uninformed retail to perform well in this market. So Yes, this actually is a mentorship course, and what we will focus on in this course. So we'll focus on how we'll be able to utilize core values of these indices algorithm with derived proprietorship business footprint. So the core value of this price delivery model, let's say boom, the core value is spike, to spike up. So how will we be able to utilize this core value and infuse it with sporting business footprint executed by Deriv? That is something we'll focus on in this course. And the second part will be focusing on basic structure and price model methodologies that works in this market. Then tracking institutional footprints. Of course, this will be a bit easy for us to do because we are dealing with just one institution here. And then utilizing inevitable price delivery models with probability. So the things that are bound to happen in this market, how we will be able to set probabilities for them and make the best out of them. And formulating small range profitable trading to take advantage of low spread. Yeah, this is something very cool from this market. The low spreads, they make it easy for you to easily make profits if you are a scalper. Yeah, so we will develop, focus on how we will formulate profitable setups. We'll teach how you'll be able to formulate profitable setup, making use of this low spread advantage. Then the next part will be mitigating the broker effect, framing low risk trading models. So okay, you don't want to expose yourself to much risk, or maybe you've been trading for a while and this market you've lost so much to it. How will you be able to mitigate that broker effect of always losing money? So we will show you how to frame low risk trading models. And finally, to cap it up, which is the major highlight of this course, is formulating high precision entries. Yes, this is an algorithm market, mathematical market. So how will you be able to understand where to snipe, where to take your shots? We are going to do this in this course. If you are in the Wall Street Fanatic group, you will be able to see some of us doing this high precision trading. Yeah, we do it a lot there. You see many results, many reports where we were very precise. Of course, we are not perfect in this market. Remember the disclaimer in the beginning of this document. Around there, fine. So if you look at this disclaimer, there is no 100% guarantee of completeness or accuracy of information, although this product presents well-researched and applied trading educational content. So we have developed consistency in sniping in this particular market, and we are going to show everyone in this mentorship how we being able to do this consistently. So I'm going to paste description of how to sign up for this mentorship course in the description box. So if you have interest in signing up, you can actually follow the instructions there. Meanwhile, make sure you stay subscribed to this channel, because even outside this mentorship course, we are going to continually paste educational content about trading to help you improve your trading quality. Subscribe to this channel and stay tuned, turn on the notification bell, and like this video. I hope